So if that's the case, where did yesterday's hideous decline come from then? There were three major causes. First, the obvious. China let its currency fall versus the dollar, and the Treasury Department labeled them a currency manipulator. China used to be really egregious about pushing its currency lower to boost exports, but for the past decade, well, they've been doing the opposite. In response to the latest tariffs, they showed us that they're still perfectly capable of devaluing their money when they need to. It was a real shock. Many hedge funds are already up huge, and when they saw this kind of craziness, they rang the register. Who can blame them? Second, Treasury yields have plummeted. A week ago, the 10-year was at 2%. Now it's at 1.71%. Historically, that's what you see when we're headed into a recession. As I told you, we're not going to have one. So when money managers see it, though, they don't consider the context, which is that the rest of the world has much lower rates than we do. They just assure we have a crumbling economy. They just assume it. It's like, hey, it's got to be. We wouldn't have rates that low. But the German 10-year is a negative yield, for heaven's sake. This is what happens when lots of money flows to the U.S. from overseas. Rich foreigners and government, well, actually, companies, trusts, they buy treasuries, which sends prices up and pushes yields down. Do not get me wrong. It's not good. It creates a strong dollar, hurts American exporters. But it's not necessarily a sign that we're headed for a recession, and it does make mortgage money cheaper. Third cause, U.S. companies with big overseas exposure are about to take a big earnings hit, or at least people feel that way. That's what they're selling. That's why they're selling Apple. They're selling Nike. They're the victims of the trade war. Somebody needs to eat the cost of these tariffs. That means many companies could be looking at slower earnings growth. That's a huge fear. However, it is also true that WATCH, which is my acronym for Walmart, Amazon, Target, Costco, and Home Depot, haven't had to raise prices much to deal with these tariffs. They have, but not a lot. This next round may hurt them a little bit. But in fact, these companies are generating some of the best sales they've ever had. And that is emphasis on ever. Overall, it is a definitively mixed picture, which is why the Federal Reserve can't be more aggressive about cutting interest rates to bolster the parts of the economy that are weakening, even as I think the Fed should, because there's no inflation and we are disadvantaged versus almost every country in the world. I am sure they're still worried that there's too much momentum to cut again. I think they should rethink. Now, if we had a better sense of how the trade war will play out, it could be easier to get a read on the market. For now, we keep coming back to the commerce versus containment dilemma. If the White House is willing to settle for a commercial deal, meaning the Chinese buy more American crops and airplanes without restructuring their economy, then our stock market will soar. But if we don't get a deal, I think we get more of the same. More of the same like yesterday. And until the past week, the same was pretty darn good. Meanwhile, lower interest rates make dividend stocks a lot more attractive than consumer product stocks. And that is one reason, for instance, why Emerson, which is a big industrial company with major China exposure, could have put really a not-so-hot quarter this morning, yet stock did well. Although the main reason is that it was already down dramatically going into the print, and it was better than feared, BTF. That was also why Apple began rebounding today. And don't get me started on FANG. Neither Amazon nor Alphabet nor Facebook have much China exposure. Microsoft wouldn't be impacted. China's not important to the new growth engine, Azure, which is their amazing cloud platform.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.